Thank you for joining us. Here we are with a webinar on financial management. I am Linda Fitzgerald. I'm hosting this webinar today. Joe Rodola will be presenting. We're so glad you're here. This is the Small Business Development Center. We're in the Shasta-Cascade region. That's far northern California. SBDC stands for Small Business Development Center. We're a nonprofit organization and we provide confidential, no-cost advisory and training services to small businesses. And the reason it's no cost is because your tax dollars have already paid for the service. We're sponsored by the SBA and the HSU Sponsored Programs Foundation. Here are quite a few of our advisors, and believe it or not, we have 40 additional subject matter experts that cover Northern California. What you can do is you can meet with one of these advisors if you are in Shasta or Trinity County and get specific support for you and your business. And Joe is a great example. Joe helped me start my business, so I'm really excited for you to learn more from Joe about financial management today.
Oops, there we go.
And our disclaimer, the information provided in this webinar and any supplementary materials provided to registrants are intended for educational and informational purposes only and does not constitute professional, financial, or legal advice. No registrant should act or fail to act on the basis of any material contained in this webinar without obtaining proper financial, legal, or other professional advice specific to their situation. The Northern California Small Business Development Center and its host, the HSU Sponsored Programs Foundation, specifically disclaims any liability, loss, or risk, personal or otherwise, which is incurred as a consequence, directly or indirectly, of the use and application of any of the information presented in this webinar. And now I hand it over to you, Joe.
Thank you very much, Linda. Well, welcome everybody. Nice having you with us today. My name is Joe Rodola. I'm the lead advisor at Shasta-Cascade SBDC. As you can see there, if you add up all those years, I am not 105, but some days I feel close to it. It's amazing how your life goes by and experience adds up. It's kind of interesting. Today, I'm using my experience specifically in the 25 years I spent in the banking industry. When I was in that field, I made small business loans for about 20 of those 25 years. I looked at business plans. I looked at financial forecasts. I looked at financial statements of businesses, corporations, partnerships, nonprofits, and sole proprietors, looked at a lot of them. So today, what I'm going to be able to do for you is pass on kind of some of they're not secrets, but they're little known things that you can look for in your financial statements that we look for as bankers when we say yes or no when you want to borrow money. How about that? So you're going to have a leg up on what we look for when we say, yeah, I'd like to give you the money, but I can't. Okay. Or yes, everything looks good. Here's your check. Okay. So it's kind of an inside scoop deal, because financial statements, you know, you look at them and you always like to see, of course, did you make any money? We all like to do that. Look at the bottom line, as we call it. But there are other numbers on that sheet that make a big difference in other ways. And we're going to talk about those today. The last thing, obviously, that would be probably the best, once you're done with this class, and if your business has been in business for 2-3 years or more, would be if you want to get your numbers worked on and figured out, right? And just because I told you how to do it, maybe you say, yeah, I'd like to have some help. Guess what? You can come to us. I can help you figure it out for your specific business. Okay? So here's what we're going to do. We're in the introduction section right now, obviously. We're going to talk about understanding the numbers. We'll talk about the main financial statements, the balance sheet, the income statement, otherwise known as the P&L, profit and loss. We're going to talk about ratios. That's the little secret that we're going to get to you on, okay? Those ratios. Those things, you know, when they say, well, you've got a 1.25 and a 3.5 and hike, you know, need to know what those mean. And we're going to try to kind of demystify that for you today. Talk briefly about cash flow and obviously wrap up. This is a 90-minute presentation. We do leave time for questions, but we cover a lot of ground, okay? We cover a lot of ground. For your individual questions about your specific business, and you're in the Shasta-Cascade area, we cover, again, Shasta and Trinity County, it may be best for you to set up an appointment to come see us, all right? You want to talk to Emily. She's our lovely admin. She will set you up, get you signed up for free service with us. Then you set an appointment to see Joe. I then work with you probably at the moment, at least for the month of September. We're Zooming or phoning only because of the increase in Delta variant. I've had my shots, but we're not taking any chances. After, hopefully in October, we'll be able to reopen again to in-person meetings, but we can do a lot on Zoom and on the phone, let me tell you. If you're coming into this class from outside our geographic zone, guess what? There are SBDC offices throughout the United States. Every city in every county of the United States, including Hawaii and Alaska, covered by an SBDC office, Small Business Development Center, okay? So there'll be a Joe type in every one of them. So you can get this assistance from them as well, okay? So you're not gonna be left out in the cold just because I'm up here in Redding, California. The objective obviously is to, do this, do all these things, okay? Maybe you'll learn a little bit about why those financial statements are worth a little more than just the bottom line, okay? That's what we're hoping for. All right, so let's start by understanding the numbers. So here we go, first page. Numbers always tell a story, and I'm a numbers guy. I can tell you that right now. People say, gee, Joe, can you really assist well in writing a business plan? I ain't that great. Okay, I ain't that, I'm not a writer, all right? A lot of people are writers, I'm not, okay? But when you get to the forecasts, when you get to your financial statements, that's where I get excited. I was a math major in college, wasn't quite sure what I was gonna do with that. You can tell though, I like the numbers, okay? So in sports and recreation, anybody out there know what the number 9 means to them? By the way, if you have questions, you can put this in the chat, or you can actually write things in the chat on this as well. That'd be great. Linda looks at this stuff and keeps me posted when a question or information posts to that. So what's 9 mean? Well, I'll just go ahead. It's baseball's getting ready for the playoffs, isn't it? We got the World Series coming our way. We'll have the playoffs coming here in a couple of days. So 9 innings in a professional baseball game comes to mind. Number 1. Everybody wants to be number 1, right? What happens in the Olympics that just passed? Everybody that comes in first place gets a gold medal. It's the only gold medal that's given out in that race. It's the person that was first. So I always want to be first. And 300. Anybody been in a bowling league in their lives? That's the magic perfect game. A 300 game in bowling. You can't get any higher. All right, can't get any higher. So numbers mean a lot in all facets. In school, you had a grade point average, right? GPA. When I went to school, the highest GPA you could get is 4.0, perfect A's. When my kids went to school, now they're in their 40s. My kids went to school, they could come home, one of them had a 4.2. How do you get a 4.2? How can you get better than perfect? Anyway, they changed the rules a little bit, didn't they? So report card. So think of your financial documents as your small business report card. Probably the easiest way to kind of look at what we're talking about here. Why are they necessary? Well, obviously, you need to know if you're making money. Because the only way we get paid as small business owners is if we make money above our expense line, right? That's our profit, theoretically, okay? And if we're losing money, we better darn well be able to adjust quickly, or what happens to the business? It sinks, okay? It gives you or provides the health of your business. Obviously, the financial statements are important for bookkeeping and unfortunately for the IRS tax purposes. And hopefully knowing that you have enough cash to open the doors the next day, okay? So here's the source of the financial statements. You have accounts, okay? So each thing has its own account. Back when I took accounting in college, we didn't have these fancy gizmos that we're looking at all this on, okay? Laptops didn't exist. Desktops didn't exist back in the 60s, late 60s, early 70s. So we did it on paper. We had these accounting pages. We at least had those. Then had separations by month. You could even buy a 12-page, 12-monther if you wanted. Most of the work we did was on smaller versions of 3-month or 6-month, but suffice it to say, we had to write it all down. And each expense category had its own page. So if you had rent, you had a rent page. If you had utilities or lights, electricity, you had a page. If you, had sales or income from various different people or organizations. I have a service business, for instance. Linda does too. We get paid from different places, different entities. I get paid by City of Reading. I get paid by City of Shasta Lake. Get paid by SBDC. Get paid by private individuals. Okay, all those had separate pages back in the day. Now you have things called QuickBooks, right? Or a simple even Excel spreadsheet that you can get. I'll add that to the list of things to send out to you. It's kind of fun. Let me just write that down real quick. Excel sheet. I'll add that to Emily's list when she mails these things out to your email. Spreadsheet. So you got the spreadsheet or QuickBooks, and that has the list, right, of individual accounts right on it. So it's very similar to the pages I had back in the day, okay? You have sales of goods, pay the telephone bill, purchase assets, buy equipment, Then you've got 5 types. You got assets, liabilities, capital, revenue, and expenses. So those are kind of the main categories of the items you might have. What's an asset? Asset is an owned something. This phone, this phone is an asset, okay? The value of that phone. The computer that we're talking on, asset. What's a liability? If I still owe on the phone, if I still owe on the computer, that's the liability, okay? Capital is the positive leftover effect, okay? So hopefully your assets, for instance, say the assets are worth 1,000 and you owe $500 on your liabilities for that particular asset. Your capital is the difference of $500, see? One minus the other equals. Revenue is the income, and expenses are what you write off against that income, and that gives you the profit, okay? Here's the common financial statements, okay? Balance sheet. More difficult to have a balance sheet if you're a service business with not a lot of assets and liabilities, okay? More difficult, especially if you operate out of your home. I have mine is a very slim balance sheet, okay? Because all I have is a phone, a computer, some paper. All I sell is knowledge. That's what I'm selling is knowledge. I don't have this watch to sell, so I don't have an inventory. Technically, I suppose if the good Lord calls me up today, my business ceases to exist. This is the way it goes, right? Unless I can do a Spock mind meld from Star Trek and transfer what I know into someone else. A break even and a profit and loss statement, of course, is that plus minus we talked about. Income minus expense equals. That's a P&L, okay? Revenue statement, all the same thing. It's all the same thing. Break even analysis, how much do you have to sell to pay all the expenses instead of you? That's what I like to call the break even analysis, okay? What would happen if you sold just enough to pay the rent, the lights, the insurance, all your little miscellaneous expenses added together? What do you got to sell? So if I knew that I had to sell 1,000 of these a month to pay for of these watches, to pay for all those expenses, I needed to sell 1,001 so Joe gets the money. See what I mean? So it's kind of important to know that you have a goal each month of how much you need to sell so that you can take home some dough. All right. And then there's cash flow. One of the things that gets mixed up in life and in financial statements is that profit equals cash flow. It does not. It does not. It's a separate thing. And we'll talk about that at the end. It's like the balance, kind of reminds you of the balance in your checkbook, right? You go to your checkbook or your ATM, you take out 20 bucks and it says you got 500 bucks left. Well, you really don't, because there's maybe checks out. You got a bill coming out tonight automatically. So, you know, cash flow is a little different, isn't it, than balance? All right. Questions so far? We pretty good.
We don't have any questions right now, Joe. I did ask people to share with us where they're located and what their business is. And a couple things I've heard already is I have, let me get this in front of me here. It says, I'm in the Inland Empire. I am in personal finance and commercial loans. And then another person says they're in Sacramento and they have an online retail business.
Very good. Well, the person that said they were in commercial loans probably could teach this thing. Anyway, so we'll start with the balance sheet. And again, we start with the basics on these classes. And a lot of these classes were invented during the pandemic. Let's be real. This whole Zoom idea obviously happened with the pandemic. I mean, these are all we used to be taught in person only. All we did, right? Show up, get the class, shake hands, have some coffee, go home. So this created this whole new environment, you know, that we have today. But the cool part about it is that we get people from all over the country. We've had people in other countries actually attend these, okay? So that's why this is obviously my opinion, my experience. They'll be tweaked a little bit depending on where you are, okay? If you're in a big city, you're in Sacramento, San Francisco, LA, New York, might be a little different than us doing things up here in the mountains, okay? Because a little tighter restrictions, a little bit more competition, okay? A lot more competition, obviously, right? If you have a restaurant, San Francisco, you're one of thousands, okay? You have a restaurant in Reading, you're one of 100 or hundreds, not thousands, okay? Whole different animal. So anyway, so let's start with the balance sheet. So the definition shows the state of financial health of your company. It's a financial snapshot. And what that does is on the day that you print your balance sheet, if all of your input is done and up to date, it will give you a financial snapshot of how healthy your business is, okay? And how does it do that? Your assets, what you own, okay, equals and always must balance. So that's why it's called a balance sheet. So the asset side of your balance sheet, which is the left, will always balance with the right. And what's on the right side? Liabilities plus equity, or however you want to call it, leftover profits from years past, It's called equity. Okay, it's called equity. The theory is that you do not have a negative equity. That would be bad. Okay, that would mean you owe more than you own. Okay, owe more than you own. It was the same thing that occurred to many people, unfortunately, in 2007, 8, and 9, when they owed more than the houses they lived in were worth. So what did that do? That created a negative equity position, didn't it? Negative equity position. And that's, of course, what created the big real estate bomb at that point. A lot of people said, well, I give up then. You know, the house isn't worth more than I owe. I'm out of here. Okay. So in business, same thing. Assets equals liability plus equity, always. We'll show you that in a number document in a minute. So what's an asset? Again, what the company owns. That includes your cash. If you have a savings for the business, it'll be a savings also, plus the checking account. If you build out for some money that people owe you, called accounts receivable, that is an asset. The equipment you own, the value of that equipment, asset. Even software that's privy only to you. It's your software, or you paid $1 bazillion and bought somebody else's software. Software could be an asset. Could be. Liabilities are what you owe to the business. So bills to vendors, if you're buying inventory, stuff, okay? If you have loans on the business that you're paying back, if you owe on mortgages on your building, accrued taxes you haven't paid yet, all liabilities, okay? All liabilities. An equity is what a company owns minus what the company owes equals, okay? What your business is worth. It's called book value. So it's book value, not market value, because market value is a little different, isn't it? Market value would include things like logos, trademark, anything registered and trademarked, anything copyrighted. All those things going to be included in market value. Location could be considered market value. Customer base can be market value. See where I'm going with this? So it doesn't just say that your business is worth $1.50, you know, because that's what the book value on the bottom line of your balance sheet says. It's worth more than that. Okay. So the sum of, so owner's equity is money invested by the owners. That's money you plunked in. Retained earnings, which is profits from a previous year. Profit and loss as of the day you print it, minus owner's draw. And theoretically, hopefully, you notice there it says plus or minus profit or loss. Hopefully it's a plus, not a minus. Although 2020 was a real, I hate the word, but challenge, right? Just to make a profit in many cases. And that's why all the disaster funding became available, was because there was a lot of negative profits and negative cash flow at that time because everybody was closed up. And here gives you a little example of the balance sheet, okay? So you take a look at it. You got your, this is not a simple, like, you know, like mine is. This is a more detailed one. This company's got cash. They got petty cash or $100 sitting in a drawer somewhere that they count. They have 40,000 out in bills that they billed out and haven't collected yet. They have $31,000 worth of stuff sitting on their shelves, inventory, 3,800 supplies. They prepaid their insurance, so they're ahead $1,500. They paid that. So their total current assets, 79 grand. Okay. Then these are current assets. These are assets that can be converted readily into cash in less than a year, by the way. What's a fixed asset? These are things that can normally not be turned into cash in a year. Your land improvements, your buildings on top of that land, and your equipment. Okay, so that's obviously a company that's got a lot of equipment. They're buying their building. They got dirt underneath that they've classified separately. And then you got depreciation. So what is depreciation? Depreciation is I like to use it in the form of the equipment. Okay. It's the amount of life your equipment has already used up. Because let's face it, equipment will eventually die. You're going to have to get new equipment, or you're going to have to repair the heck out of it. Okay. Or maybe it's gone out completely out of style, and they got to buy a new piece of equipment to keep up with competition. So there's all sorts of reasons, but depreciation is the usage of that piece of equipment. I like to call it in my thinking, I call it funny money, because it's not really cash. It's the estimated amount of life your equipment has lost. And there's certain numbers you put to each type of equipment, by the way. It's not just willy-nilly. You don't just pick a number. There's accounting rules that come into play here. And that's why I always suggest that if you have this kind of involved financial position, you're a corporation or an LLC that's got a lot of employees and a lot of equipment, and you're not an accounting whiz, have one. Okay? An accountant, a CPA, bookkeeper minimum, and they know all this. Yes, that's right, Abigail. And they know all this stuff and why it's where it needs to be. So they can answer your questions, they can keep you straight, and you don't have to go, well, what did I put in that? You know, it's important. The other thing this tells me that this is a bigger company is you got intangible assets, goodwill, and trade names, right? So if you have a duck that quacks and talks on television, okay, Aflac, okay, that's worth money. That's worth money, okay? Golden arches of McDonald's, that's worth money. All right. The Geico gecko, he's worth money. Okay, these are all trade stuff, not probably copyrighted, probably registered trademarks. All these things come into play. You have to follow procedures to get that done. Okay, to get those things qualified. And goodwill is that customer base is a good kind of explaining what goodwill is.
Joe, can I jump in with a question from the chat?
Yes.
It's what is the amount of the cap for something that is an asset? Is there a cap of $1,000? Would a laptop be one you bought it for $750, for example? And would you depreciate a laptop? Some people say there are only 2 years of life for a laptop.
Oh, if Abigail would have the answer to that better than I.
Abigail's asking the question.
You're the one asking the question. All right, cool. See, when you need Rebecca, where is she? No, Rebecca's our QuickBooks specialist and QuickBooks trainer. So she would have the answer on the top of her head. Depending on the business size, okay, anything could be in the balance sheet asset. I'm in the same boat that you are, Abigail. I have very little. I just have a laptop. You know, I just paid, I think, I upgraded mine and mine's only $700. You know, it's not an Apple, you know, I don't do them. It's an Android. So and I've got an Android phone, paid $600. So technically, those are my assets on the asset side. And yes, you depreciate those very quickly. That's why each piece of equipment has a different level or term of depreciation. If you have a big cat, you know, I'm not a kitty cat, but a grader, right? A big, huge piece of equipment. They have life expectancies. All right. they have 10 years or 7 years or, worth of life expectancy, and they depreciate annually. Okay, they depreciate annually. So that's why it's very tough for us, and Linda too, where we have home business and we don't write off our bedroom, for the most part. We don't write off our personal lights, so we don't have lighting expense. I don't do it anyway. They don't want to get involved with all that fancy dancing, okay? We just don't have a lot of this. So it's very difficult, you're right, for a small service business to have a balance sheet that means much. All you'll probably have is cash in the bank, cash in, you might have inventory if you got some products you're selling. That's about it, okay? All right, so liability side, obviously you got current liabilities. Those are liabilities normally payable within a year. So you owe $35,900 here on some kind of accounts payable. Okay, you probably have product you purchased that you have to pay out. You got some wages that are payable, haven't paid their paychecks yet for this month. And you have taxes payable you accumulated, but you haven't paid them yet. Okay, so current liabilities. Notes payable, this is the next one. These are things that will be payable sometime, but not the first 12 months. Equipment loan, outstanding balances, and there you go, $220,000, $220,500 in liabilities are total owed. So the good news is you've got total assets of $721,000, total liabilities of $228,500. You have a wonderful stockholders' equity of $500,500. Okay. So what that's telling me is, in just looking at this and this alone, with nothing else that I know, they're pretty good company. I'm happy. As a lender, this is important that you have retained earnings, a lot of retained earnings. That's money that profit's been accumulated over the years, 440 grand. Okay. These people have stock involved, but most of us won't have stock. So that's, again, showing that this is a bigger company, obviously. It's also showing this is a corporation. So, but you have a solid stockholders' equity of $500,500. That means that your assets are worth a lot more than what you currently owe. If you had to liquidate, okay, this is kind of the snapshot we're talking about. You had to liquidate. As a banker, I'd say you're in pretty darn good shape, okay? Because you can sell the buildings, and the land and the equipment, get rid of that, even if you had to lower the price on it. And you could get rid of all your liabilities relatively quickly. Okay, get rid of the inventory, okay? Only thing, if I'm looking at this as a banker, that I'm a little bit kind of about is the fact that there's not a lot of cash. Not a lot of cash in this business. $2,100 in the bank. Got a lot that's incoming though, 40 grand in the receivables. You build out a bunch. You got a bunch coming in at this point. Okay. But you only got 2,100 in the bank. Rest of this is solid. We call this a solid balance sheet. Okay. And again, this kind of explains more about how the balance sheet, the numbers again we talked about. There's two types of assets. Current assets typically can be converted into cash within 12 months. I talked about that. Cash, securities, accounts receivable, inventory, prepaid expenses. Second asset, typically not converted or will convert in longer than 12 months in a normal life, life situation. Your buildings, your equipment, intangible assets, and depreciation, obviously the funny money. The total assets are derived by adding the current assets and the fixed assets together like they were on the previous page. Two types of liabilities. We talked about that. You got the current liabilities at the top. Again, typically due within 12 months or one business cycle, normally an annual, either a fiscal year or an annual regular calendar year. That includes your accounts payable, payments to the vendors, your buying product, current portion of long-term debt, that's the payments that you're making monthly. Balance on revolving debt. It's always considered stuff you got to pay back quickly. You don't want to have, hopefully, long-term debt on credit cards. Accrued payroll taxes you got to pay, and accrued sales tax you got to pay to the state, because you're always accumulating that. If you're selling retail products, you always have accrued sales tax, because every time you sell something, you got to collect the tax, and then eventually monthly or whatever you send it in, right? And payroll taxes, of course, is if you have employees. If your only employee is you, it's different. It's different. You normally would not have payroll tax. Okay. You might, if you're a corporation, pay yourself through a payroll program. Most sole props and small businesses are sole proprietors, so it's a little different ballgame. Second type of liabilities, again, are the long-term portion of the debt. So your real estate long, it's a 30-year loan, 25, 20-year loan. Equipment debt could be a 10-year piece of equipment. You're paying it off in 10 years, that kind of thing. And notes payable, that'd be the leftover amount that wouldn't be paid in that 1 year time cycle. So total liabilities, you add the current and the long terms together, makes sense. And then owner's equity is the difference. Pretty simple. Net worth of the business components will vary based on ownership structure and business type. Retained earning derives from net profit from the P&L. So when we get to the P&L, we'll show you where the net profit comes from. It's obviously your bottom line, your net profit, and that slides directly over into, if you don't pull it all out and spend it, of course, it already slides into your owner's equity, okay, in the form of retained earnings. Any new quick questions of any kind?
No, we've caught up, Joe.
Cool. So let's, Joe, balance sheet we've now covered, okay, balance sheet. Now we're going to the old P&L, income statement, revenue statement, whatever you want to call it, okay? I call it P&L because that's old school. So one thing about me, man, I'm old school. So the income statement or profit and loss is based on simple mathematical formula, right? Income, the stuff you take in, minus the expenses, the stuff you pay out, equals what you got left over. Simple math. It's called net profit. So what you sold minus what you spent, how much is left? Okay? Simple idea. Basic structure of the income statement for all businesses are the same. However, the income statement may vary from business to business based on industry, business structure, preference, level of detail, accounting methods. So that's why I always suggest, if you have a real intricate business, you got 5, 10, 20 employees, you got subsidiaries, different offices, have a CPA. Boy, I'll tell you what, you cannot discount a good bookkeeper, CPA, accountant. Never. They're worth their weight in gold. Okay. They not only keep your financials straight, they can warn you about things they spot, because they may spot it on the numbers quicker than you can. And they keep you cool with the IRS. One thing about it, you do not want to upset the IRS. That's the federal government tax people. As a small business, you want to do a couple of things. Just as a little side note, pay your quarterlies. If you're making money every quarter, pay your quarterly estimated tax. Stay ahead of the game so that you don't have a big bill in April and have to pay a fine, okay? And they will fine you. if you don't pay enough taxes during the actual calendar year. Okay, calendar year, there's a fine. Okay, I call it a fine. If you can't pay it all off in a calendar year and you owe taxes more than your available money to pay them, April 15th, they will do payment plans. Payment plans. Don't let it go to the point where they start, coming after you legally. You cannot bankrupt out of IRS debt. It normally is never forgiven. There's a program you can apply for to try to go through and give them financial documents, so forth and so on, to try to get some of that dispelled. It's an IRS program direct. But for standard op, just know that an IRS debt is normally never forgiven, follows you to the grave. So you want to keep them happy. And if you make a pay plan, nothing negative happens to your credit report. Nothing. How do I know that? I've done it. That's why. Okay. I've had a IRS debt bigger than I could afford and had to put it on a pay plan. So here's your income statement. Okay. Kind of a standard. This is a different company. This is a widget company. These are in thousands of dollars, but the numbers stay the same. So you had sales revenue. You sold widgets. That's $4,125,000 basically. You had repair kits for the widgets, sold 143,000 of those. You got repair, you got service. So you perform service, you have service revenue, 1,000,004. So the total sales revenue is 5,000,007. So you look at that and you go, wow, that's pretty darn good. And I've had people come into me and tell me, yeah, Joe, back in the 70s, 80s, and they'd come into me, and I've been working with them for years, in the bank. And they come and say, hey, Joe, I sold $1 million last year. How about that? And I'd say, hey, congratulations. What'd you make? Well, make is down here. Okay. And when they said to me, oh, I didn't make anything, I made zero. And they wanted to borrow more money from me as a banker. Okay. Don't leave that net income at zeros. Preferably, you got to make some dough. Okay. You got to make some money, especially if you want to expand, buy more equipment, get a loan for that equipment. Don't ever show zero here. Tempting, because then you don't owe the IRS a dime, do you? Right? But try not to show zero on that bottom line. It's very, very difficult to borrow more money when you have nothing left. Okay, nothing left to show. So that's the revenue line. Then you have sales costs in this case. In other words, this is cost of goods. A lot of people have had to deal with cost of goods, especially on some of these finance grants through the federal and state government, and the loans, the EIDL disaster loans, all might have been affected by cost of goods. So in this case, for sure it's a retail establishment, because it cost them $2,204 to originally buy the widgets and then sell them. You see where I'm going? Repair kits cost money, and their service costs money as well. In this particular case, they're not making a whole ton of money so far on their service. So it's offered as a customer value, okay? Because you had $1,400,000 in service income and almost $1,200,000 in expenses for that service. So therefore you go, oh, wow, So if somebody was looking at this company, I look at it and I think, well, if there's one thing I was going to not do anymore, I may not have a service department. Not making me much money, is it? Okay. So then the gross profit, when you subtract all the cost of goods out, you're down to 2,000,003 here, gross profit. Whoop. And then of course you've got your other operating expenses, general administration, sales and marketing, research and development. So this would include, buildings, lights. It's not broken down very detailed. Most of them are. But you had $1.9 million in total operating expenses. So you subtract that out, now you're down to 400 grand. Interest paid, another $1,000. So now you're down to 399. And then you got some taxes that you got to pay. So 127 in taxes that's owed on your profit. And that leaves you with your net income of 272,000. See, so that's the bottom line. That's what you got left for this particular year in this case. Okay. So let's talk about income again. Income is derived by adding up your sales receipts for the period. Don't wait too long to do this. I've actually waited a couple, 3, 4 months sometimes to put it into my accounting program. Do it often. Do it often, or give it to your accountant and have them do it often. Don't wait. This again should be income from normal operations, from either selling products, selling service, whatever you're selling. Okay, this is typically not one-time payments of some kind. Like if you sold a piece of equipment, that would not be here under income. From sales, okay, that would be a different situation there. So net income is derived by taking income and subtracting returns, discounts, merchandise sold that was returned, discounts given for any promotions. There's your cost of goods. We talked about what that cost of goods was. It's the money you paid to buy the thing. So if I had, let's do the pen. I like doing the pen. So here's a pen. Say you paid $1 for the pen. That's your cost of goods. Okay. You sell it to me for $2. That's your revenue. So $2 minus the $1 I paid to buy it, it's $1. And that's your gross profit. Okay. Because you don't have any other expenses out of it yet. But in a simplified world, that's it. Right. What I paid, what I sold it for, profit. Okay. And again, gross profit not to be confused from net, because you haven't subtracted all the regular expenses out at this point. And expenses are everything else. Okay. You could have sales, you could have general, you could have administrative, you could have operating. And again, these expenses include utilities, rent, salaries, office supplies, payroll expense, et cetera, insurance, et cetera. So some items may be included in cost of goods, like if, sometimes if you're building something to sell, you would put the expense of that building of that something into the cost of goods. You could do that. How much you've used, for pay your people to make the thing, right? Just depends on your accounting preferences. And then again, your accountant can assist you with those questions. Operating profit derived by subtracting expenses from gross. Okay. And net profit or bottom line is bottom line, the last number on the page. Okay. Okay. And that amount, in the case of that last $272,000 sample we looked at, that $272,000 will be transferred directly over to retained earnings if you haven't pulled any money out in an owner's draw. Okay. Or you could transfer the 272 and actually show owner's draw on the balance sheet, depending. Profits and loss. Remember, profits are not confused with cash. It's not the same animal. Okay, so profits do not equal cash flow. That's true. Okay. And profits are used for 3 things: paying down debt, reinvest back into the business, and distribute to you as the owner. That's what profits are for. Okay. I fixed that. That was wrong last time. I fixed it. Yay. Want to make sure it read right, and it does. Effective profits can be seen on the balance sheet. Profits flow to the balance sheet as retained earnings. We just said that. When profits are used to pay down debt, liabilities go down and owner's equity goes up. Because remember, it must always balance, right? Debits equal credits. That's one of the things about accounting that I loved was you have to balance. You have to balance. It's like a checkbook. If I don't balance my checkbook, I freak out. My wife used to go, you're a couple pennies off. What? Yeah, well, some people are a little crazy. That's probably me. So anyway, and when profits are taken from our business, distribute to the owners, assets go down, owner's equity goes down. So again, it's all mathematics, every bit of it. Effective losses can be seen on the balance sheet. Losses flow to the balance sheet by decreasing retained earnings, of course, or reducing owner's equity at the bottom. That is the case. Many people, unfortunately, in 2020 might have experienced losses, and that's unfortunately the effect that it will have. Okay. And then you have to use cash reserves, or get some of these grants or loans that were made available. By the way, those of you who may still be experiencing slowdowns due to COVID, there's still some money out there. If you have questions on what is available from the U.S. government that may be able to assist you, please contact your local SBDC and ask what's left, okay? Because we've been kept apprised of all of that. And in fact, today, for those in the state of California that have not applied for the state of California grant program, it reopened this morning. Now, if you applied for the state grant in January, you can't apply again if you're still pending. They're still working on those. But if you never applied for the grant before, the state of California grant's open as of today. As of today, you get 5, 15, or 25 grand, depending upon your 2019 sales. And it's a grant. If you get qualified and you get it, you don't got to pay it back. Worth checking into if you have not already applied and you're still experiencing financial difficulties coming out of COVID. Excuse me. Okay, so losses funded by debt, using credit cards, line of credit to fund losses. It just tells you what the effects are. Losses funded by the owner, and an owner may have to inject money into the business to keep the business going. Distinct possibility. So putting it together, the income statement is a picture of how management makes decisions on how to price their products and services and how successful they are at allocating resources to achieve the profit. So in other words, how do you price what you're selling minus your ongoing expenses? Is there anything left for us? That's the way I like to look at it, okay? I had to raise prices on my services to compensate for cost. My insurance costs went up, my rent costs went up, my lighting costs went up for utilities, heat and air. You got to be able to, how are you going to cover? That's why we're experiencing inflation in our country today. That's exactly why it's happening. Gas prices are up, everything's up. They pass on the expense to us for wood, right? Lumber, whatever, food. It's all happening. Any questions at this point before we jump into the coup de grace, the financial ratio section?
We don't have any in the chat, but if someone wanted to turn their microphone on and ask a question, you're welcome to do that right here.
Now, so far, we kind of covered basic tracking and what the numbers, where the numbers come from. So that's what we basically covered so far.
All right, we're ready to go forward.
Cool. Now we're going to cover kind of the fun, for me, the fun part, okay? The financial ratios. There are a bunch. So I'm not going to bore you with the fact that there's a bunch. We're going to cover a few key ones, okay? Key ones. First, we're going to start with liquidity ratios. They are ratios that tell us how effective we are at converting current assets into cash in order to cover our current liabilities. So that makes sense, right? You have a current asset. Say you got this pen. How quickly can this pen sell? Okay. To cover the fact that we had to buy this for $1. Maybe we put it on, we bought a lot of these. We may have actually, gotten these in our warehouse, but we haven't paid them yet. You gotta wait for the bill, right? You gotta wait for the invoice. So you got this waiting to invoice. So let's sell these as quickly as we can. So by the time the invoice comes in, we can cover it. That's the key. If you got this sitting on your shelf gathering dust, a lot of times what do? We'll discount this product, right? And get rid of it quick because it's not doing us any good. It's just taking up shelving space. So retail's kind of a tricky scenario. It's kind of interesting to me. All right, so let's talk about these financial ratios in this area. We got working capital, the current ratio, and the quick ratio. These again are basic ratios that us as bankers look at, that you can look at to again see how well your business is doing. Okay, the working capital equals your current assets, that top section of your financial statements. Okay, current assets on the balance sheet minus current liabilities. The hope is that you break even, at least. Hopefully it's above, okay? So what you want to do is have more money in current assets than you do in current liabilities. Okay, if the number is negative, if you owe more in the current liabilities than you have in the bank in your current assets, you may be headed for a cash crunch, okay, and should be prepared to raise enough working capital to meet the needs. In other words, you got to sell. Okay, so you don't want a lot of current assets. Oh yeah, current liabilities, because then you got to cover it with what you got in the bank, your accounts receivable. You might want to think about collecting that as quickly as possible, right? If you have a collection group, people that call on bills that haven't been paid, or if you have a vendor that is historically late paying you. I'll give you an example. I bill for one of my classes on the 11th or 12th of the month. Okay, I bill. I don't get paid on that bill till the end of that month. It's actually a pretty good turnaround, in my opinion, because I'm dealing with an entity, government entity. Okay, a lot of times you deal with government entities, you'll have 30, 45 days till you're paid. In my case, it runs about 2.5 weeks. So I know that when I bill for my class I teach, and I bill them, I'm going to get paid by about the 27th, 28th, 29th of the month. Historically is how it works. Okay. So you need to know that to be able to understand your cash flow. The current ratio is current assets divided by current liabilities. Okay. And that again is you want that higher than 1. Okay, higher than 1. So the hope is that you have, say, a current assets of $5,000 and your current liabilities are $4,000. Yeah, right. So your working capital is $1,000. There's the difference, and it's above 1 on the, when you divide it, it's above 1, like 1.2, 1.3. Okay, if the number is less than 1, again, your current liability is greater than your assets, current assets, you may have to come up with some more dough to pay those bills. Okay, And then the quick ratio or acid test used to be to determine if we have enough working capital to meet our needs after we remove inventory from our current assets. Okay, this is because inventory typically takes long enough or the longest to convert to cash. Should be as close to 1 or higher as possible. So in other words, when we did these first two, working capital current ratio, we included inventory in that figure. Okay. When you do the quick ratio, it's cash, accounts receivable, and any marketable securities you might have. Most businesses don't have marketable securities. Most businesses have cash plus accounts receivable. That's it, right? And then you divide that by current liabilities. Again, your hope is you have enough cash and accounts receivable to cover those current liabilities. And we check that as bankers all the time, all the time. So when you bring in those figures to us, we want to make sure that these are within tolerance. Okay, now, people sometimes ask me, and it's come up before in these classes, what about my type of business? Okay, so I'll give you an example again. Small service business. I don't have a lot of current liabilities. Very few. Okay, I still have a little payment on my laptop I'm making, but that's it. You know, so my current liabilities are very small. If you're a big corporation, your current liabilities might be huge. Okay, so each individual type of business will have a sweet spot. And I will try to find that for you and send that out to you as well. I think David found it the other day, our boss, he's a great guy, our director. And that is financial ratios by business type. I'll try to find because online you could just about find out anything about everything, right? And so we'll try to find you that. The other way, of course, to do it is come in and see us or call us, set up an appointment. We'll do the numbers with you. So that's better yet. I'd like to talk to you individually anyway. Find out what your business is about. Okay, what type of needs you have, what type of equipment or things are you going to want to buy? Because I can help discuss that with you and sell you nothing. Yes. For 25 years in the banking industry, I had to convince you I had the best deal in town. Now I get to tell you how to do it, and I don't have to sell you anything. It's great. It's great. Okay. So I can do that non-biased, which is very good, and calculate your ratios with you right at the, right online or eventually in October on the desk. Okay. Okay, so that's quick ratio, current ratio, working capital. These are basic ratios, by the way. These are not the most technical. We'll get into those. Financial ratios, again, the number 2 laws may indicate potential problems with on-time payments to vendors. Could result in vendors moving to COD or, basically having to pay upon arrival. Okay. Leverage ratios tell us how we are paying for assets, things we own. Debt to equity ratios, total liabilities divided by owner's equity is our debt to equity ratio, okay? A number that is too high means that the business is using too much debt to finance those business assets, okay? We don't like to see a lot of debt on the business. We don't. Let's be realistic. And we don't like to see the debt on the business larger than your current assets and total asset figures. Never, never. There's a problem then. Definitely a problem then. Okay. So let's talk about profitability ratios. They tell us how effective a business is at converting assets into profit. Okay. So the gross profit margin is your gross profit divided by sales. A number too low indicates the cost of goods are too high, and the amount of revenue remaining for operating expenses may be too small. The goal is 0.5 or higher. So as you can see, these numbers don't have to be big. They don't have to be big. They just have to be in the correct direction. Okay, the correct direction. So gross profit divided by your sales revenue. Okay, that's gross profit margin. Your profit margin is net profits divided by sales. So you just go one line down. Let's say you go one line down. Indicates how successful the business is at earning profit from their revenue it generates. Okay, but the goal is to just be a positive number. It varies by industry. There again is what we were talking about earlier, is that if you're a manufacturer and selling something you make, these numbers will be highly different than a small mom and pop service business. They won't be the same because you've got a heck of a lot more expenses and more intricate numbers than a mom and pop sole proprietor service business. Okay. If you are a lawn maintenance small sole proprietor business, that's a lot more intricate than my service business of selling information. And that's something. It's still a service business, but I don't have lawnmowers, trailers, trucks to pull them, trimmers, blowers. I don't have a lot of assets. The lawn maintenance people have a ton. So it's a whole different ball game for them as a service business than me and Linda as a service business that is teaching, consulting, advising. We're selling different type of services. We don't have any equipment to speak of, except for a laptop, maybe and a phone. But they have all this extra equipment. And the other thing they have that's a lot different than we do, much higher liability insurance for the business. Plus, they'll have to have equipment coverage as well, right? So you have equipment coverage, you have liability coverage, but if you're mowing lawns, cutting trees, chainsaws, climbing ladders, the risk is higher for them than it is for us sitting at a table talking to somebody across the table. So it's a whole different animal, okay? But to calculate these figures is the same. We pull them from the same place. They just mean different things for different types of businesses, okay? I'll try to find you that financial ratio by business type information for you. And definitely, if you're interested in finding out how lendable you are, how lendable you currently are as a business, because you're thinking of adding a new piece of equipment, you're thinking of moving maybe into a bigger place, you're thinking of buying a building instead of renting it, all those things, that's where the SBDC shines, okay? We can advise you in all those areas using a consultant in the finance field to give you those figures, tell you what to work on, tell you what to fix. The other thing we can do here at SBDC, because we're talking about your financial numbers here, there's one other big glitch that unfortunately sometimes rears its ugly little head. And that is, what is the owner's personal credit look like? Okay. There's another piece that can be worked on. And we can advise and assist you in getting those scores raised. Specifically, I love doing that. That's technically what I did for 13 years. When I worked for CCCS, I worked for Consumer Credit. I was the director of a small office of CCCS up here in Shasta County. We help people with credit issues, try to fix it. That's important. So not only do you have to prove you're making money, but you have to prove that you've been paying your bills on time. There's a little bit of an, it's not just a single-edged sword. It's dual. It's dual. And guess what? We can help you with that for free too. So none of our services are cost, knock on wood. None of our services currently we charge for, we're already being paid by our tax dollars. You might as well spend you're already paid you're paid at the office, right? Your tax money is already paid for this. Use us. Use us. We have marketing. We've got HR. We've got restaurant specialists. We've got you name it, service specialists. We got bankers, ex-bankers. We got we got marketing people. We got some fabulous marketing classes. We'll give you some connections at the end here on how to look up some of this other, our other webinars. We've got hundreds. Hundreds of webinars available for you that we've taped just like this one. Okay. You'll see my bald head in several of them. Okay, continuing, return on equity. That's net profit divided by owner's equity. Okay, net profit. These ratios measure the return on the funds invested in the business and retained earnings. So it's return on equity. The higher the number, the better. Varies by industry. And of course, a good ratio is at least 0.5 or above. Hopefully it's positive. That's going to be the key. And the one that bankers always love the most and is sometimes the most difficult on the surface to identify is debt service. Debt service. Okay. And here it is, this last little equation. Principal plus interest payments on your current and additional monthly bills for the business divided by profit. Has to be 1.25 or above to qualify. So here's what, remember early on today, I talked about the guy that said, hey, Joe, I sold $1 million worth of stuff. And he's bragging at it, right? He comes to my desk and I ask him, well, how much did you make? Nothing. Here we go. Debt service just went down the tanks, the tubes, because he has no profits. He's showing zero. See what I'm saying? So gotta show some profits. Gotta show some profits. If you're growing, I mean, you're gonna end up on the IRS. I know that ain't fun. I know it. My wife and I have both been self-employed. She's been self-employed for 22 years. I've been self-employed for 10, the last 10. Before that, I was being, got paychecks from people, right? This is standard, work for a corporation. Okay, fine. But once you start having profit or loss and you start paying your IRS and your state debt through your profits and something called self-employment tax, those of you who have been, especially in sole proprietor positions, remember your self-employment tax. What's that? That's your Social Security. You got to pay that too, right? In fact, in most cases, my Social Security or self-employment tax is higher than my IRS debt is to them. So you got to make sure you got enough money to cover both. All right. So ask your tax person on that one. Make sure you know. So debt service, you gotta have positive debt service. If there's negative debt service, man, I'll tell you what, it can be an automatic no before you ever get to what the heck you're trying to accomplish. Okay. There are situations where a loan could be given on an anticipated increase in sales and profit. In other words, if you add another truck and you're a delivery business and add another driver, and you can add that much more income to the pot, it still might make sense. Okay, it's not going to be an automatic no. But in most cases, debt service must be a positive number. Okay. Trend analysis. This is just given to you for you to be able to work these numbers out if you wish for yourself. Okay. You can print this out. You can make an Excel sheet. Probably the easiest way to do it is to make your own Excel sheet. And then you put these down. Okay, for your whatever period you want. This is set up right now for 4 quarters. You can do it quarterly, figure out your ratios, right? And there's several of them here, and they're all, here's how to do the calculations. So there's your working capital we talked about, current and quick, we did that. Accounts receivable turnover, okay? That gives you how fast your accounts receivable is coming in, okay? Number of days it takes for you to get your accounts receivable paid. Inventory, how long does your inventory sit on the shelves? That's a cool one for those retail people. Accounts payable turnover, okay? How quickly you pay your bills and how many days it takes to pay them. And there's your debt to equity again, gross profit margin, return on equity. So those are all of the major ratios that bankers like to see and are an important piece of the success of your business in knowing what they are. Okay. And if you do an Excel sheet, you can actually set it up. And I'm not sure, Rebecca's got a class later on this month. I believe QuickBooks can do them for you. QuickBooks, I believe, can set up a lot of these ratios automatically in your QuickBooks to be able to print these babies out after you input the numbers. That's the way to go in my book. And again, trend analysis is to make sure that things aren't slipping. That's exactly why anybody does trend analysis, right? You do that simply by doing bottom line. All of a sudden you get a month, you didn't make any money. Why? Got to find out now. What was the reason? And you can trend analysis these ratios as well, okay? Comparing period to period obviously involves laying the financial statements out in order. By period, placing the information on a spreadsheet, which I gave you on that previous slide, kind of an idea how to do it. How are we doing, Linda? Before we jump into the little cash flow, I think it's the last thing on the list.
We don't have any questions, Joe.
Cool. So cash flow. Cash flow in. Sales, revenue. So when you sell something, you've got cash coming in. When I have a class and I charge somebody for that class and they pay me, give me a check, sales revenue. If I sell an asset, you might have income flow or cash at that point. Okay. Loan proceeds. So you get a new loan, you're going to put it in towards the business. That could be money that you're having cash flow, right? And obviously investment in the business if you personally dump money into the business. Cash flow in. Cash flow out, operating expenses. You pay the rent, boom. You pay the lights, boom. You buy something, an asset purchase. Might be cash flow out. Loan reduction, you pay back principal on a loan balance. It's always nice to be able to do that early, right? That'd be cool. Because all those have an effect, and of course, owner's draw. Cash flow out could be you taking some money out of that baby. You got to pay some, you know, you want to go fishing and go golfing. My 2 downfalls, there they are, fishing, golfing. Now you know. Okay, positive cash flow is not the same as operating profit. Okay, negative cash flow is not the same as operating loss. Cash in the bank is not positive cash flow. Okay, so there is a difference. There is a difference. Okay, Because cash, money makes the world go round, that's for sure. Okay. Analyzing cash flow trends. 3 rules of effective cash flow management. Plan, 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 and I should have added check, check, check. Check it. I'm going to bring up something that's another class altogether, and that is risk. And I'm talking now about risk for your accounts. Risk for your accounts, okay? Fraud, people taking identity, people taking money out of your credit card account without you knowing it. People unfortunately taking money out of your checking account, savings account, you don't know it. Not a bad idea to have protection nowadays, people. This is a personal note. We have had several things occur with my wife and I. We do not know how in heaven's name it happened. We have a feeling it has to do with online purchasing. Sorry. Now you know why I like to walk in a store and give somebody cash, all right? Can't take that out of my account, can you? It's already out. Cash flow. There's personal cash flow for you. But you got to have yourself protected because you just don't know. So always keep an eye on your balances, on your credit card balances and your bank all the time. I have in-home banking for everything. I can press a button and know immediately what my checkbook has in it and what happened last night. Always have that. Don't ever take it for granted, okay? This day and age, people are stealing us blind and we don't know it, so. Okay, and there are protection companies doing it. A lot of credit card companies will offer you free or discounted identity theft protection. And there are several companies out there that'll also offer it as well for a fee, a monthly fee. Not a bad idea, not a bad idea, okay? All right, we're wrapping it up. Any final questions that we have left?
I don't have any in the chat, Joe. I did just put our survey link in the chat. We would love to hear what you think of this webinar. And really, this is our way of showing our funders how we're spending their money. And we really want to provide what you're looking for. So if there are other webinar topics you'd like to see, please let us know. Go ahead and click that link. It'll open a new window and you can finish it after the webinar.
Thank you very much. Yeah, that is a very important piece. We wanted to know what we've done and how we do it. So turn in the seminar evaluation. This is, again, is normally done live. So that would be, I'd hand you one, you fill it out. We don't let you out the front door. Oh, now we can't do that, can we? Because we're all on this little screen. But you get the idea. We really love to hear from you. And obviously, if you want to delve in after you get this copy of these slides, if you want to delve in to your personal situation with your financials, and you don't feel comfortable enough in running those numbers, because I'll tell you what, I got one daughter that loves math. I got one daughter that doesn't. You know what I mean? Everybody's got their strengths. And the one that doesn't like math is a writer. So there you go. See? So they all have strengths. But some people don't like the math. So come in and see somebody like us, somebody like me. We'll help you do the math for you, with you. We'll show you how it's done. I love doing that. That way you're prepped. That way you're prepped. Maybe you're not ready to borrow money. You find out. Maybe you're ready to rock and roll. We'll find out anyway too, okay? And here's basically our last slide. We are located at 1305 Sacramento. That is our current address here in Redding. We again serve Shasta and Trinity counties. SBDC offices cover all counties in all states, including Alaska and Hawaii. Emily is our main contact. She's our admin. Man, I'll tell you what, she keeps us on our toes and keeps us straight. There's our connection for our website to sign up for those free services, sbdcsc.org. If you want to find out an area of where your SBDC office is located in your geographic area, there's how to do it. Just hit that link. Boy, there you go. And then there's all our links to Shasta-Cascade's Facebook page, Twitter feed, LinkedIn, and YouTube channel. And the YouTube channel, in my opinion, it's the coolest. I love YouTube. I'm sorry, that's my thing. If I want to find out anything about anything, and if I want to fix something, or, I go to YouTube because they'll tell me how to fix it. And we have a ton of these webinars already saved. Linda's done several. I've done several. All of our consultants have done many of those already on there. You can just sit there with a glass of wine, in the evening, take a look, all at no charge. We also have something on there called NorCal Minutes. And those are quick snippets of information that we have that we are offering to you. So check those out too.
So if we still have a couple minutes, if anyone has a question, they'd like to turn on their microphone, they're welcome to ask now. I don't see any microphones going on, Joe. Great job today.
Thank you very much. It's all a pleasure. Thank you all for coming. I hope it was informative for you. And again, we love to assist. That definitely, back in the early 70s, late 60s, when I got out of school, I went into banking because I wanted to help people do important things. My dad had been in banking prior, loved the fact that every day he went to work, he was helping somebody buy a car, a business, a house, whatever it was. Make an impact. I still get to do it here at my kind of retirement age. This is my semi-retirement job right here. I love it. I continue to help you guys. I will do it till I can't talk anymore. How about that? But that's what we're here for, is to help. Linda is the same way. We've got a ton of people. Rebecca's QuickBooks class, I've heard one of the best in the state. One of the best in the state, her class on QuickBooks. So take advantage. And all of it, again, already prepaid. Bingo. Have a great day. If there's nothing else, Linda, I guess we're ready to rock here.
We are wrapping up. Thanks so much, Joe. And you will receive an email from Emily in a couple days, in that she is going to include the slide deck Joe used, a link to this recording, and also the link that Joe referred to for finding out the financial ratio for your business type. So look for an email from Emily in a couple days. And thank you for joining us today.
Thank you all very much. Have a great afternoon.